Hey, what is up, guys? Stock market continues to show weakness in many sectors, as many leading indices officially in the bear market dropped by more than 20%. In this video, I will take you through a brief history about recent two recessions and explain why this upcoming recession could be the biggest than previous two, can potentially drop by 73% or more. During the late 20th century, the internet created euphoria attitude towards businesses and inspired many hopes for the future of online commerce. For this reason, many internet companies known as .coms were launched, and investors assumed that the company that operate online were going to be worth millions of dollars. But obviously, many .coms were not tremendous success, and most of that were successful were highly overvalued. As a result, many of these companies crashed, leaving investors with significant losses. In fact, the collapse of the internet stocks caused the 2001 stock market crash even more than September 11, 2001 attack. Consequently to that, the market crash cost investors a whopping $5 trillion. Internet entrepreneurs were obsessed with the dream of becoming .com millionaires or even billionaires. Those entrepreneurs were inspired by companies like Amazon, eBay, and Cosmo. Of course, for every company that grew to be a multi-million-dollar business, hundreds of those failed. Many investors foolishly ignored the fundamental rules of investing in stock market, such as analyzing PE ratios, studying market trends, and reviewing business plans, instead of investing based on hype. Furthermore, they ignored these signals that bubble was about to burst, and of course it did. Stock market at the peak of .com bubble was at around $1,500, which was in April 2000. This bear market lasted for more than 2 years. Slowly and painfully it decreased all the way to mid $700. That would be 50% decline. At the peak of the .com bubble, interest rates were at 6%. Fortunately enough for the US economy, Fed was able to save the day. They lowered the interest rates all the way to 1% at the bottom of the bear market. By lowering interest rates, artificially they stimulate economic growth, since consumer savings decreases and corollary to that, consumer spending increases. Therefore, economy had a nice stimulation. Stock market had a steady growth for 5 years or so, until it had another bubble. Housing bubble and financial meltdown. The crisis has reached a dangerous point. It began with the burst of US housing bubble in 2000 after a long period of steady increased house prices. More families were able to take out mortgage than previously possible. Lenders had started engaging in practices called subprime lending, lending to risky borrowers who would not normally be qualified for mortgage to buy a home. I guess your dog could qualify for subprime mortgage too. The subprime mortgages typically came with low interest for a few years and then drastically increased. The risks were usually not fully explained, and many borrowers were told that they could easily refinance their mortgage in few years to keep the interest rates low. Economists warned of this danger, but for the most part nobody in the US wanted to interrupt the party atmosphere of the housing bubble. Everyone seemed to be making money. Construction companies, real estate agents, bankers, and material firms. Happy consumers were able to own a home for the first time in their lifetime. But in 2005 and 2006, it came time to pay the piper. Interest rates on the subprime mortgages shot up. Many new homeowners were unable to pay or refinance their home. Unfortunately, the bankers and lenders making those loans sold debt to other investors. The debt assets had been diced up and sold to other investors and banks around the world. Bankers packed all those shit subprime mortgages into a bond, sell those bonds to other banks and financial institutions in Europe and all over the world, transferring their toxic liability into other hands. But eventually, all this scheme came to the end. As a result, many people lost their homes and their jobs. Banks and financial institutions suffered tremendous downside. Or didn't they? Oh yeah, that's right, they got bailed out by government. Nevertheless, the stock market dropped from its peak of more than $1,500 all the way to $700. That's slightly more than 50% decline. This bear market lasted more than 1 year and a half, much shorter than previous dot-com bubble. Many people lost faith and confidence in government, but they were helpless. They couldn't do anything about it. But those who did start inventing something new, completely different, unrelated to central government, and that something was a Bitcoin. More on this on other videos. At the bottom of the bear market, Fed once again were able to save the day. In addition to lending cheap money and free money for financial institutions, they dropped interest rates once again. Interest rates were lowered from 5% at the peak of the housing bubble all the way to 0%. And of course, it stimulated another economic growth. Until last September, we were in the longest bull market in the history, until stock market showed weakness in many sectors as many indices dropped by more than 20%. Even though the housing bubble is fading into a history, but the root of the next might be already have started. Fast-growing pockets of debt, as in the last time around, look like a potential source of the problem. They were nowhere near as big as a mortgage bubble, but no blow-up appear imminent. The amount of American student debt, roughly $1.5 trillion US, has doubled since financial crisis. It is now the second largest category of consumer debt outstanding. Public colleges and universities hurt by state budget cuts increased tuition. The drop in houses value also made it harder for families to tap into their home equity to pay for tuition. As a result, the financial burden shifted to students, who took and behavioral debt led to pay for their school. The truth is about student loan, unlike other businesses, you are not able to declare bankruptcy, even if you cannot find a job. Student loan will haunt you for the rest of your life. Many borrowers are already falling behind in 2018. More than 10% of student loans were at least 90 days past due. That was down slightly from a couple of years ago, but higher than the peak of mortgages during the last crisis. Companies are also loading on debt. After the crisis, central banks slashed their interest rates, investors moved their money out of the government bond, which were paying essentially nothing, and they piled into corporate bonds, which typically pay slightly higher rates. American companies were more than happy to satisfy investors' revenue appetite, and they did so by selling debt. There are signs that borrowers' brink may have gone too far. Debt issues by non-financial companies is near its highest level, as a share of the United States economy since the World War II. In the past, such situation has been followed by the rise in defaults. But the difference between 2000 dot-com bubble, 2008 housing bubble, and this upcoming credit bubble is that in 2000 and 2008, Fed was able to save the day by decreasing interest rates and launching QE, which happened in 2008. But this time, they are out of their main stimulants. Current interest rates were recently increased to 2.2%. They recently announced that there will be 2 upcoming interest rates hike in 2019. Therefore, interest rates won't help. QE is also already done, unless they want to destroy US dollar and continue to print a large sum of this fiat currency, which may lead to hyperinflation. They probably won't do that as well, since they are out of their main stimulants. Therefore, it might be one of the biggest crises we have ever seen. Let's take a look at this chart for the past 20 years. The top of 2000 and 2008, it might be our first support line. which is around $1,500. If stock market drops to this support line, it would be an ordinary 50% drop. But I believe this is not ordinary market. We are out of artificial stimulants. Therefore, Fed will have to figure out something new. While stock market can continue to drop and reach second support line at the bottom of the dot-com bubble and housing crisis, this line is around $800. That would be 73% drop from the all-time high, and for the stock market, that would be a huge deal. It would mean we would be hidden in the deep recession. So we came to the end. Let me know what you guys think about this upcoming recession. Could this be the biggest recession in the history? Leave your thoughts in the comment section below. If you enjoyed this video, hit that like button. And if you are new to this channel, do not forget to subscribe for more animated videos about cryptocurrency and financial markets. Other than that, thank you for watching. See you next video.